Okay, what's up, premium members? I just finished recording the live account update. I was like rushing to get done with it because I'm so excited to make this video. This one is going to be really dense, meaning it's going to be full of a lot of information, but it's not going to be long because the information is pretty concise. So let's talk about that. We're going to be talking about candlestick structure. So this is the advanced candlestick and market structure video. So on the candlestick side, we're going to be talking about advanced candlestick structure as far as like one simple concept of whether your candles have wicks on them or not. And then the other, for the advanced market structure, we're going to be talking about SNDR theory. So breakers, SNDR, whatever, right? So first, we're going to start with some drawings, and then I'm going to pause it, and I'll find some examples with actual candles, and I'll show you some examples with actual candles. For candlestick structure, basically, let's get that one out of the way first. The drawing, essentially, we're talking about this concept of a pullback, right? So when we have a candle here, this is our candle. Everybody wave to the candle. That's the wick. So you got your candle that is, let's say you're trending up and you're looking for a pullback, and this is currently the highest bodied bullish candle. So let's say that we have another candle right here. Right. So as you can see, I'm doing something with the wicks here, and that's on purpose. So when we are in candlestick structure, or when we're in bullish market structure and we're looking for a high, we're using candlestick structure to identify that high. So as of right now, as far as you know, we need to close below this candle to make a pullback, right? So then you would get a candle that comes like this, closes below it. Maybe it's got a nice wick up here like this, right? And yeah, I mean, if you are going on the assumption that this is correct as of right now, then you've learned everything that you should have learned by now. I mean, you're right so far, but what you don't know, what I'm going to teach you right now, is to look for wicks, because if candlestick structure is using fractality, then we have to use wicks to identify pullbacks, right? You can also use the lower time frame to identify pullbacks, okay? But wicks are going to be an easier, quicker way to mark out structure overall without having to always zoom in on the lower time frame for every single pullback. So the better thing to refer to is the actual candlestick structure rather than just zooming in every time. So this is a problem because there's no wicks here, right? Because there's not a wick here, then what we're showing essentially is that, and there sometimes can be a little wick down here, but especially when this candle doesn't have a wick and you go higher with a body, what you're typically 9 times out of 10 looking at, so when I say 9 times out of 10, that means we refer to it as a rule that we are going to rely on a consistent basis. So this is my rule that I use for the candles, right? If we don't have wicks here on these candles, then, or at least on this candle, then we would still need to look for closure below this. Because if you're thinking about the fractality again, then you're looking at it thinking whatever the wick was right here, we have a high, we have a low, we would have a high if there was a wick, and a low, and then a high, and then a pullback would be closing underneath this candle, which would make that a flip on the time frame down, a pullback on this main time frame. But it's because there's not this wick, we assume, because it's true most times, that we're not seeing that fractal model of a flip here, And so we need prices just going up, meaning our actual structural low on that time frame just below is all the way down here. So a lot of times how that manifests in price is you'll see price like range around with these candles and eventually come and close below, right? And then we'll go and you'll think, okay, now once we've gone higher, I have a protected low here. And so because you think that's a protected low, and because, or not this, but you think this is a protected low because you think this is a swing, and then you actually end up getting stopped out because you identified a trading model inside of this zone, right? Whatever your trading model is, you identified a trading model in this zone, and that trading model didn't work, and you're thinking, man, that sucks. And then it does it again, and then it does it again and again in the same scenario, and you're like, I don't know if I trust this system. It's because this fractal thing with the candlestick structure is very important. So that's why this is in a separate video, advanced candlestick structure. Very necessary to know this. I kind of wonder if I should have put it in the core content and just not made a second video, but I'm relying on you guys to get your money's worth for premium and actually watch this. So here's this, and then let's go ahead and talk about supply and demand. Let's talk about SNDRs, so S&D responsible, right? Breakers. And then we'll go and find some real examples in price for this model. If I can find one or two, I'll be happy, because I don't remember where they are, but I know that they're somewhere. So let's go ahead and take a look for that real quick after we get into the SNDR. But first, let's talk about the SNDR. So in a nutshell, just to paint the picture with using the path tool for starters, we're going to be drawing imagine in your head that we've got two different time frames that we're going to show, and I'll actually change the color so that you can take a screenshot. I'm also going to have diagrams. I'm working on the diagrams still, going to make them and put them out, put them on the diagrams channel, but I feel like video takes priority for sure. So what we're looking at is currently the 15 minute is swinging up, right? So this is the 15 minute. And let's say that we come down here and we make a structural flip to the downside, right? So I didn't change the color here. I'll do it like this. This was the 15 minute, and now I'm going to zoom in and show you what's going on the 1 minute. And I'll go ahead and change the color of this one to red. So hopefully you guys can see that difference. I'm colorblind and I can see that difference, so it should be good enough for y'all. So the blue is 15 minute and the red is 1 minute, okay? So imagine you're zooming into what's going on here. This is the fractality of it. So essentially what we've got is a swing up, and a flip down, right? On the blue, on the 15, it essentially just looks like this. Okay? But we're zooming into the 1 minute to show what's actually going on. So what's going on in the 1 minute? We made some sort of pullback or maybe a flip up and maybe then a flip down. Not really. I mean, it can be, let's just say it's a pullback, right? It's a 1 minute pullback. It's not a flip up. The thing never flips up. It just flips straight down on the 15, and it never flips up on the 1 in this scenario. So right here you have your zone, okay? This is your last protected zone. That means that you're in an uptrend. You had an external high. You closed above that external high, and between the external high and the lowest point before going and closing above it, you mark this out, and then it turns into a flip zone right here, right? But prior to it turning into a flip zone, prior to you drawing it out that way, think about what caused this change in structure. Obviously, it was the 15 minute coming and closing underneath this level right here, okay? It was the 15 minute coming and closing beneath that. But what caused the 15 minute to go close beneath that? That is where SNDR theory comes in, and we'll talk about also how to, how I am studying trading it right now. Maybe something that you guys can also research with me. I sent a trade idea yesterday morning. I said I'm not taking this, but this is a trade idea, something I'm forward testing. That was part of SNDR theory, and it was like a total banger trade. So essentially, the idea is that you're using the fractality of structure to identify the one time frame down, identify the zone one time frame down. So in this instance, it'd be the 1 minute zone, right? That caused the break of structure on the 15 minute. So right before you go and close below this, right? On the 1 minute, which zone caused that? Okay. On the 1 minute, which zone caused that? And this is really advanced, but also if let's say that we don't have actual visible 15-minute structure, right? And we just have 1 minute structure, and the 1 minute is, let's say it's trending down, and then it flips up, okay? And then it flips down, and then it goes and makes a fake flip zone, right? This whole thing, so it's the same thing as a 15-minute swing. Even if it's not a 15-minute swing, we still consider it the same if it's a fake flip zone, because you're in this group and you know that secret, that truth, right? So imagine, this is still the 1 minute. Let's change it to the 1 minute. Color. Red is the 1 minute. So even if you don't have the 15-minute model, this was the SNDR of a fake flip zone on the 1. So we treat it the same, and we trade it the same, or we theoretically trade it the same, right? Because this is SNDR theory. So let's go back to just the original example with it just being the 15-minute, okay? Just like this. So how do you trade it? How am I currently trading it and forward testing it in some scenarios, actually trading it in other scenarios? Personally, how I'm doing it is I am using the touch of the SNDR for a continuation trade, so long as this lower time frame in this instance is the 1 minute, remains in this instance bearish, right? So what that means is if there's no extra swing here, I'm gonna switch this back to red. Hang on, and blue and then red, and then save. Hopefully that changes it. Let's see. Yeah. Okay, so let's say that price makes a swing again, right? Price makes another swing, and then to get back up into this 15-minute zone, price flips, structurally flips up, okay? Price has structurally flipped up now. So on the 1 minute, we have simply put a flip versus a swing. So in this instance, I am not taking a tap or a lower time frame entry confirmation, because this is currently opposing structure, right? So even if the 5-second flip down here, I'm looking for 5-second flips up here until the 1 minute flips back bearish, and then I'm looking for 5-second flips down, or I'm just looking to take that 1 minute flip and put my stop up above the 15-minute swing and just hold the thing and hope that it continues down, right? But in this instance, you would need to wait. In my opinion, I wait. If we make another swing and prior to coming back into the SNDR we have to flip bullish, then I am not taking the SNDR tap trade. I'm waiting for price to come up to somewhere in here. It doesn't have to always be the 50. It can be lower, it can be higher, and make its flip down. And then I'm taking a trade, which is just a trading model that I'll cover in another video. I already have the video written in my notes. It says I got to do structural trend trading model. So that's my most basic trading model. This is it. It's the 15-minute swing or flip. It's the 1 minute flip inside of it. Same thing with the 1 and the 15, or 1 and the 5 second, 1 minute, 5 seconds. Same with the 2 hour and the 15 minute. That's the one that most people know to begin with. So I'm just going to go over a simple, model video after this for that, but we're not talking about that right now. What we're talking about is the SNDRs. So in this instance, I would not be taking this trade right here, okay? In this other instance, right, we have this SNDR, and we make a swing here with the SNDR, but we don't make another swing. So we remain bearish. So we don't swing down and then up, right? We don't swing down and then flip up. We just go out and we climb back up and touch the SNDR here. Then I'm looking for trades out of it, back down to the low that sent me out. So this is, if you're picking up what I'm putting down, this is basically the preemptive Mark II. This is how you would take a trade from the Mark II as it's being created if the trade wins, right? Because then this would be the Mark II for later on if price goes and then comes back. So essentially, this is how I have been setting the trade up, just like this. I've found that when I tried to hold the trade past this low here, the win rate decreases significantly. And I mean really significantly. It's not just like a little bit, like you can get more out of it because on the ones that win, you get a higher RR. I think it's not a good idea to try to hold it past this unless you're talking about moving to break even and then setting just taking taking most of your profits and then using runners, because it is so frequent that it'll just touch here and then come back in and then might even lead to a flip up, but you can still scalp this trade opportunity right here from the SNDR. So again, this is, and I want you to also notice that I drew that we're, prices kind of marching up. It's different for me personally, and this is where discretion comes in. This is not mechanical, and I'm sorry, there's not going to be a mechanical answer for you because you can't really make something mechanical on like whether price looks scary or not. But if price just closes out and then the next candle just bulldozes all the way back up here, I personally am going to stay out of its way. Even if that causes me to miss out, I would rather miss out than take something that's like too great of a risk to lose, like lower probability to lose. I'm more inclined to play defensively than I am to play offensively in the market. And it would be an offensive play to hope that this works when, from my experience personally in the market over the period of time I've been trading, when price moves this violently up into that SNDR or back up into that zone, you're better off not trying to take this SNDR trade. So again, I'm going to go ahead and find an example for the candlestick structure and for the SNDR model right here and cover it now. Let me just pause this and go look for those. Okay, so this example doesn't have an actual pullback on it. I'm going to keep looking for better examples, but I just want to take a moment to touch on this one real quick. This is an example where you would need a closure below this candle. So even after putting in this candle right here, this guy, because there's no wick on top of this one. So if, let's say, price was to come down right here, we would be needing to see a closure not just below this candle, but a closure below this candle to consider this a valid pullback, because it's likely 9 times out of 10 that this is the last protected low on the 15-minute and that this is just a fractal non-structural low on the 15-minute. So let me look for more examples. Okay, I found another example. I think this one should suffice. It actually has to do with the pullback, and then we're going to move on to SNDRs. So right here, this is a wick, but it's not big enough. I mean, you have to think about, relativity. This is one single point of a wick on a candle that is very large. How many points is this candle? 83, right? So there's no exact math to that, but just use your head. So essentially what happens is we put in this high-bodied candle right here, and then barely any wick, if at all, but we do go close above it, and so now this has then become the point of validation for a pullback, and that's not a good place to be in, because especially if you're a trader who trades longs on pullbacks. So like if you're a trader who, for instance, looks for, let's say on this time frame, you're looking for a structural pullback, and then you have a trading model that tells you want to catch the lows of each pullback and then take the trade through the high, right? If you thought that this was a structural pullback, you might be getting induced to take a trade there for a long preemptively, which I don't think is a really good trading model, but I know some people kind of do stuff like that. So I'm just putting it out there. This is part of the reason why it's important. Really, it's not a pullback when we close below this, because we're pretty certain looking at this that the 15-minute did not make a high, a low, a high, and then a lower low right here. Structurally. Maybe fractally, but not structurally. So we actually need a closure still below this candle instead of below this candle, right? Once you get that closure, that validates the highest point up as the high. And that makes, once you come up and close above it, this entire thing a swing, rather than, the swing having been up higher, essentially. And that ends up working out just fine. So basically the importance of this is actually being able to perfectly identify market structure. The candlestick structure is going to influence the market structure, because if you're trending up, you're needing candlestick structurally sound highs to make swings, right? And if you're thinking that something's a swing and it's not, you're not going to understand what I'm talking about in the market. You're not going to know perfect market structure, because you don't know perfect candlestick structure. And if you don't know market structure perfectly, like I said, then you shouldn't be trading with money yet. You should still be studying market structure and learning until you get it perfect. So rewatch this a couple times, rewatch this part a couple times, what I'm talking about here, but you see this lack of fractal highs and lows here, because the lack of the wick here, that means we need to go close below this candle rather than this candle up here. Okay, so let's move on to SNDRs now. I already can think of a trading example, of a couple trading examples, and then we'll be done and you can get to the next video. Okay, I actually love this example because it's from the 15 and the 1, like I was using just now for my draw out. So this is of a flip zone and also a fake flip zone. So this is an SNDR of a fake flip zone, which makes it all the more powerful, which I really like. So let's break down what happened here. So this is the fake flip zone. It's also just a single flip zone up. If you don't understand what I'm talking about, you shouldn't be watching this video. You should be going and rewatching Invisible Market Structure. Go rewatch Invisible Market Structure, then come back to this. Right here though, this is a 15-minute flip down. This is a 15-minute flip back up. So how did we flip back up? Let's look at the 1 minute and find where exactly that happened. So structurally speaking, where that happened was right here. This swing right here was the structural flip up, okay? This 1 minute was trending up, and this was the last structural swing before the 15-minute went and closed up out, right, and made its flip or its swing up. So it doesn't just have to be a flip on the 15, it can also be a swing. This happened to be a flip and a fake flip, so very powerful. Almost really wish that I did take this trade, because I feel like I'm more familiar with it than I thought I was. But how I marked this trade out was essentially just identifying your low tap back, which is a video that I'm going to make. It's going to be very brief, talking about low tap backs versus Mark IIs. A low tap back is essentially just a Mark II but in a swing instead of a flip. So in that instance, if this was a flip, you would see that the Mark II is right here. It's not a flip, it's a swing, so we refer to it as the low tap back. But yeah, I'll make a video on that. It's gonna be very short, probably like 5 minutes. Yeah, here is the SNDR trade. So essentially, if you're using these liquidity concepts like the Mark II low tapback, you would have your entry here. If you didn't know, and your stop loss will be down here. If you didn't know that, then your entry would just be right on the top of the SNDR. There's a common misconception for people to be looking for the 50% of the SNDR, or like 30% or the 70% or whatever those people like try to teach to trick you guys into losing money and buying more prop accounts. All that stuff is not needed. It's essentially just, you know, going below that lowest tapback, or at the very least putting it up at the top of the SNDR right here. Okay, so the trade that I highlighted for you guys was this one right here below this sweep, because we break above and close on the 15, flipping up, fake flipping up. And then notice how the 1 minute never flips down. Okay, so does it trend down? Yes, like it climbs down, right? It climbs down, hits it, and then runs up. Okay, so it didn't just go up out of the 15 and then dunk straight down, right? It didn't go up and flip up on the 15 and then make a valid pullback here and then go higher and then flip down and trying to take this trade hoping it flips back up, right? What it did was it put in this candle that it needed a closure below. This was the candle that needed a closure underneath, okay? Look at the fractality of this, right? We have a high, a low, a high, right? And then this is our flip down on the 5 second, okay? This is our valid pullback on the 1 minute. This is our first time we get a valid pullback in this entire leg. So this is what we would need to go close above to make a swing. We don't go close above it, so we don't make a swing. So currently, structure says on the 1 minute that our only swing is right here. Our last swing is right here, and market structure is still bullish, and this this supply and demand zone was responsible, SNDR, for breaking structure or continuing structural swings on the higher time frame, the 15-minute in this instance. So let me go find an example of when to not take the trade this way real quick. Okay, actually the example is not very far away. It's just basically one swing behind on the 15. So this is a 15-minute swing up, okay? This is a 15-minute swing because we put in a external valid high, and then we go close above that valid high right here. And this is also a 15-minute swing as well, right here. We might actually be able to find 2 examples. Probably not, but we'll see. So let's talk about, actually there are 2 examples here. So I'm gonna go over both examples and then we'll be done. Here's the 15-minute swing up, okay? I'm gonna go ahead and highlight this. Let's get rid of this one for now. I'll go ahead and highlight what's going on right here. And then we're gonna zoom into the 1 and go find the spot. So over here, check out what's going on in the 1. What's going on the 1 is that this right here is the structural SNDR. It's the structural SNDR because this cluster of 1 minute candles right here is the 15-minute closing a body right here on this candle, okay? So the 15-minute closes above, making this a swing up, all right? That makes this, or even potentially, actually it could even be this, the SNDR, right? Because we have a high, it gets closed below, and then we go up. This could possibly be a 5-second flip down and up. I'm not gonna go look right now. But you know, all intents and purposes, let's just say it's this. Doesn't really matter. It could be either because it runs through both of them. And this is a great lesson in why you need to pay attention to the market structure. So once you close that 15-minute and then the 1 minute makes another swing, why am I marking this out as a swing? Because we have our highest bodied bullish candle, and then we end up going higher with it, higher with it, higher with it here. And if you're looking for a higher body than this wick even, you've got a confirmation from here. So all confirmations that are needed are here to show that this is in fact a valid pullback. We make our valid pullback, okay? And after making that valid pullback, whether it's below this candle or this candle, we swing up and go close above that valid pullback. That makes this a structural swing on the 1 minute. Because this is a structural swing on the 1 minute, right? Anything that happens below this, if price goes below this, that is a structural flip down, okay? If price makes a structural flip down, then we're not taking the SNDR seriously anymore. We're not using it as a place to look for trading models personally, because it's 1 minute swing structure versus 1 minute flip structure. And a flip overpowers a swing. Like I've said before, I've said it on live stream, if you're playing rock, paper, scissors with this stuff, you know, rock beats scissors and paper beats rock and scissors beat paper, right? Swings beat flips most times, especially when you're on the same time frame. So a 1 minute flip is likely to beat a 1 minute swing. That's all this is, just a 1 minute swing, right? So when we have flip structure to the downside, we're no longer looking to take this tap right here, okay? And as far as this other example next door, okay, we've got another example next door right here. This is a 15-minute swing. I already showed you guys. If you want to pause the video and go back and look, just so you can see the 15-minute. But I'm going to visualize it, help you visualize it, because we flip down and then we flip up. This is a 15-minute swing, okay? And this is the SNDR of the 15-minute swing. Boom, right there. Now look what happens. Rip through. You would get stop rated and then it would go up and you'd probably try to, you know, chase it. I don't know what you would do. I really don't know how you guys are trading. But this is the structure on the 1 minute. Okay, and watch what happens in this instance. So would you take the SNDR tap here if price is bulldozing? So this is not the same example, right? This is a different example. I talked about 3 examples. One is the good trade. Price stays bullish, right? The trend stays bullish the whole time on the first example. It slowly trends down on the lower time frame into the SNDR, staying bullish the whole time on that same time frame, the 1 minute, and then reacts, right? And then we've got price structurally flipping down before hitting the SNDR, and now we have price aggressively ripping down before hitting the SNDR. So all 3 examples. One of them, in my opinion, is qualified for trade opportunities. 2 of them are not. This is the second example of one that is not, because once we close up here and we start to come down with this massive volume, right? If we're increasing in volume as we're heading towards my SNDR instead of decreasing in volume, right? Then I'm not looking to take this tap. We go so vertical here. There's no consolidation on the way up. There's very little consolidation on the way down. Once you get underneath this, it's just a straight dive down, okay? These non-structural lows, it's just a straight dive down. This is not, and this is discretionary, this is not a place that I would be looking to take an SNDR trade from. I wouldn't even put it on there for forward testing. I know it's not gonna work. So what you'd be looking for is for the 15-minute swing. This is the 15-minute swing. You'd be looking for price to come in here on the 1 minute, make a structural flip up, and then you can be looking for longs in the most basic trading model there. And then same thing goes for here. You know, you're looking for that flip up, right? And then, you know, taking your longs. So we come down into not the 50, but the 15-minute swing. We make a structural flip up, and then after that structural flip up, you're taking your long opportunities. That's the basics of, you know, market structure, trend-friendly trading 101, just from a mechanical standpoint. But yeah, that's the SNDR theory in a nutshell. We're not doing, you know, we're not taking SNDR tap trades after price has flipped structurally against it. and we're not taking SNDR tap trades that have tons of volume going against them. Okay. If you guys have any questions, as always, please message in the premium chat, and I will talk to you guys soon. Going to be working on the next videos here in a bit. So stay tuned. Peace out.